After a week dominated by the Reserve Bank and inflation, today the Reserve Bank put out its latest statement on monetary policy. This is where it updates its economic forecasts and also fleshes out its thinking about where its settings sit right now. And they have changed, I've got to tell you. So let's bring in here Warren Hogan, independent economist and a consultant at the small business lender Judo Bank. Warren, thank you so much for your time as always. I think the key here, and we got some sort of glimpse of this earlier on when Philip Lowe gave a speech to the National Press Club, and then before that in their statement that accompanied their decision from their board meeting earlier this week. They have changed the forecasts, but they're still saying, no, inflation's not out of control. It's not going anywhere. We don't have to hurry with these increases in interest rates that the markets are forecasting are coming.
Yeah, g'day, Ross. Yeah, I think that's exactly the right summary. They are walking slowly towards the sort of the view out there in the market that inflation is more of a problem, but they're walking very slowly. They're reminiscent of where the Fed was 6 months ago. That is that we're going to have some temporary elevated inflation, and they now have headline inflation here in Australia getting to 4% or almost 4% this year, and underlying inflation above 3%, but it'll come down again. And this is despite now forecasting officially unemployment at 50-year lows over the next 3 years, i.e. sub 4%. So they're not anticipating that low unemployment rate and the implied tightness of the labour market is going to show up as higher wages. So they're very comfortable for now that this is a temporary inflation shock and that's going to recede as the year progresses, and that when we do start to see that labour market tightness come through, it's not going to be a problem for them.
Okay, so overnight we see the Bank of England having 4 of its 9 members of its board suggesting that its interest rate should have been raised by 0.5%, not 0.25% after the 0.25% they raised them by in December. The worry that you have had consistently, you've mentioned this a lot, is if the Reserve Bank here gets this wrong, they're behind the curve and they could be forced to raise interest rates very, very suddenly. That could be the danger if this strategy is not correct, if these assumptions about Australia's economy are wrong.
That's exactly right. And actually, I think that it's likely that that's what's going to happen, even if they can remain patient for another 6 months and get more momentum in the economy post the pandemic, get the unemployment rate lower. When they come to having to actually start the process of lifting rates, normalising interest rates, getting them back to a more sustainable level of, say, 2 or 3%, that they'll have to do it quickly because the inflation sort of momentum in the economy could be quite significant, as we're seeing overseas right now. I think we're 6 months behind the rest of the world. The Bank of England's talking about 50. They've gone twice in a row. The Fed is talking about that they will go 50 if they have to. And it's all because of the starting point. It's not that we're starting from a position of neutral policy or normal policy. Monetary policy is really, really easy. Interest rates are at 0 and they've got to get up to around 2 or 3 to even be regarded as normal. So there's a lot of work to do. And I think you're right. When they move, they could have to move quickly.
But isn't there a grave danger there from a policy point of view? If you raise interest rates in the next couple of months after the election campaign once, then 3 months later again, 3 months later again, it's gradual increases. The people get used to the idea of those higher rates. If you suddenly have to come out because you are forced, because you've got your assumptions wrong, to raise interest rates 3 or 4 times in the space of 2 months, then all of a sudden you've got a shock to the economy that really maybe, again, consumer confidence, business confidence cannot bear.
Well, that is a risk for sure. And there's actually a similar but opposite risk, and that is that when central banks start tightening, and we're seeing that in Europe and we're going to start to see that with the Fed, is that because real interest rates are so negative or so low and overall interest rates are so low, is it actually doesn't have much of an effect. And then they start to have to chase the higher inflation along and really accelerate things. So it all ends up in the same place, is that they're behind the game and that they have to risk actually putting the economy into recession or damaging the economy significantly in the process. And that is a very real risk. And I think that's going to be something the market, the equity markets, property markets are going to have to face up to in the next 6 months. The US will be telling on this front. And I think we should all be watching what happens there because I think that'll be a very important lead for the rest of us.
Good stuff. Warren Hogan, independent economist. Always good to get you on the program, and we'll speak very, very shortly.